Good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, July the 16th, 2025, recording this just after 7 o'clock in the morning. Okay, so let's just have a quick look and have a look at the CPI yesterday, because when the number first came out, the initial market reaction for 5 or 10 minutes was relatively positive in terms of it was a little less than expected. So the front end of the curve went up, so the yields went down, the dollar went down. But after the market, spent a few minutes just analyzing the subcomponents, that's what I want to do here for just a couple of minutes. It soon became apparent that this was a result which would make it difficult for the Fed to cut anytime soon. Nothing dramatic. It's not as though inflation, we're not here. If you look here, we're not at sort of 2022, 2023 levels. But the point is, as you can see here, if you look at this first chart, which has the basic sort of subcomponents, you can see that we're starting to tick upwards. And if anything, at the most optimistic interpretation would be to say that we're at some sort of lower plateau and sort of flatlining and probably ticking up a little bit. So if you have a quick look at this, you can see that the major component here is still sort of core services. So one argument is also that the core goods, where one would have expected most of the tariff impact to have sort of arrived, it's not really, it hasn't really shown up that much. So there could be potentially worse to come over the next 2, 3, 4 months. So if you look at the core goods, you can see that was sort of negative going back like 12 months or so, but that's now starting to creep up a little bit. And you can see that the core services, nothing sort of nasty, but it's still remaining fairly robust. Food also is not going down. I will see in a second the problem with that. So this is the issue with the Fed, that inflation is not nasty. It's not sort of ripping higher as it did here. You can see going back a couple of years here, but it's certainly not getting back to target. And therefore, with a strong economy, a strong labor market, and the possibility of more inflationary pressures coming as a result of the tariffs. The easiest spot for the Fed really is to do nothing. No need to hike, but no need to cut. But of course, we all know that there's a massive political pressure happening. Even yesterday, Trump, after these numbers, what did he tweet? Something like, cost of living low, cut now, or something, which is not exactly the correct interpretation. Okay, sorry, just having a bit of tea. All right, let's have a look at a couple of others. So let's just look at the core goods. And what you can see here, this is the core goods contribution to CPI. And you can see here that indeed is starting, the direction of travel here is tending upwards. So again, nothing nasty, but the point is here that this was actually below zero for, quite a sort of a period, sort of, 12 months, 18 months, whatever. And it's definitely going upwards. So, could that be a harbinger of something to come? It's possible. The other thing as well, I don't have the chart with me, but I was looking yesterday. If you look at some of the sort of the items which are going to be potentially the most impacted by tariffs. So we're talking things like household electronics, communication goods, sort of luggage, toys, a lot of this stuff which not regular people buy. Just as a consumption, that has definitely started to sort of pick up in price. And we're still fairly early days in the sense that a lot of companies are probably using inventory. Remember, inventory numbers were tried to front run the tariffs and were built up. So the thing is that a lot of companies are still selling into consumers' inventory, which doesn't necessarily even reflect the new tariffs, which could become more apparent, sort of in the July, August, September numbers. Okay. And then if you look at other measures. So this is also looking at things like the trimmed mean, the median CPI, sticky price, and the supercore. So these are different ways of looking at inflation. So supercore is, sort of core services excluding sort of housing. And then you've got sticky prices, prices which are just very difficult to come down. The median and the trim mean is just different ways of chopping off the most volatile ones. For example, a lot of these come from the Cleveland and the Atlanta Fed. And the point I'm trying to make here is that even if you look at some of these alternate measures with a bit more detail, you can see that of course, inflation has come down over the last 2 or 3 years, or let's say 2 years, but it's now starting to plateau, as I said, reach a sort of a base and seems to be ticking up even with these alternate measures. And the problem here as well, sort of politically and just for people, is that if you actually look here, let's look at the wages. So the issue is that when we had a lot of nasty inflation, back 2 or 3 years ago, the reality is that a lot of wages, especially for the bottom sort of quartile, so the bottom sort of 25% of wage earners, their wage wages were actually going up quite a lot. So in a certain sense, that was compensating for the increased cost of living. But the problem now, which is also is political and also, sort of could have real effects on society, is that if you look at food inflation here, even food inflation is starting to tick up a little bit in the black. And you can see here that if you look at Anticor, so the food and energy as an index, that's also sort of seems to have reached the lows, pushing up. But the problem here, look at wages for the first quartile. So the first quartile, as I said, is kind of like the bottom 25% of income earners. And you can see, unfortunately, that seems to be going downwards. So this is going in as not such a great direction. And the point I'm trying to make here is that if you look when inflation really spiked back, a couple of years ago, nasty spikes, but you can see here in this a gray line that actually inflation that wages for the lowest income earners was actually in some sense keeping up with it, or at least was rising. But now we have an opposite tendency and they're going in opposite directions. And that spells problems because that was one of the big issues which got Trump elected. And that was one of the big issues which was a problem for voters with the Democrats. So if the Republicans, sort of want to keep an eye on the midterm elections in 2026, graphs like this are not going to be good news. And finally, just to give it just a sense of, some of the pressures building on everyday life here. This is the price of coffee. I've been watching this sort of the coffee contracts, and just interesting that look, this is the US CPI instant and freeze dries coffee. So a lot of the coffee comes into the States from Brazil, and we know that apart from the specifics of the coffee market for Arabica beans, Trump is now sort of threatening 50% additional tariffs on imports from Brazil. And you see here that that's sort of pushing up higher. So that's just one little potential sort of, item in your sort of supermarket basket of your coffee, which is sort of going up. And I know myself, my own personal beans have gone up, have doubled in the last 2 or 3 years. So it's definitely, all of these kinds of issues are going to sort of start biting at the ballot box and politically. So just getting back to markets as well, as I say, the initial reaction was relatively positive. But then the market, if we just look here at what's being priced in for the Fed as a sort of a baseline, we can see here that, it's been around about 2 cuts by the end of the year. And you can see that yesterday we're down now to 1.7. So we're only down to 43, let's call it 43, 44 cuts by the end of the year. So yesterday the market took out a full 6 cuts from the pricing. And you can see that now for September, that's gone down to, more or less a coin toss. So about 55% for a September cut. And forget July, the market's completely priced that out. And we can see that if we just look at the intraday chart, so a very short-term tick chart, this is pricing in terms of basis points here on the right for by the end of December. And it's essentially what we just saw. But you can see here that we're now at about 44 basis points of cuts. And this is the 50 level, which is down here. And you can see here that had been kind of creeping up over the last 3 or 4 days, but just with the data release. And what I want to point out here, guys, is that you can see that when the data initially came out, and this is like literally the first minute, it was actually dovishly repriced. So we pre-data, we're at about 45, 46 basis points. And just immediately on the release of the CPI yesterday, we got down to about 50. So initially there was a dovish reaction, but the market, as I said, once it took a few minutes just to look at the individual line items and just look at the individual sort of subcomponents, it suddenly realized that this was not a comforting number for the Fed. Nothing insane, nothing crazy, but certainly not a number which is justifying dovishness, despite what our friend Donald Trump might have to say. Now, sort of a corollary of that is that if we just look at a couple of other markets here, we can just see that the dollar index pushed higher. So you can see here this on the daily for the dollar index, the DXY. You see that's pushing higher, big green candle, kind of stabilizing. But this is quite an interesting moment here because it's almost as though the market is coming to an accommodation saying, hey, Trump is a bit crazy. The tariffs are going to go up and down. What is finally going to be instituted is going to certainly be higher than we've had historically for 70 or 80 years. But is it getting to the point where the market will slowly kind of price it in, or at least sort of ignore it? But just technically here on the dollar, we can see that it was very, very, very oversold. It's been in a downward trend here for sort of a long, long time. We'll just put on some of these EMAs. You can see here that it's been in a downward trend essentially for about 5 or 6 months. So is this just a sort of a dead cat bounce here? It's actually quite a critical moment for the dollar because as you guys can see here, the overall trends are more or less still downwards. So the momentum is downwards, but you can see that the 20-day moving average is starting to turn up, and it has bounced off the lower trade range at about 96.90. Now, the thing is, there's a lot more work for the bulls to do. We haven't yet got above the 50-day moving average. So this could just be, just a little sort of reactive bounce, oversold, a little bit of a short squeeze. Absolutely, is that possible? And if we just start putting a few little fib levels here, we can see that from the shorter term impulse going back to even May, which is not that long ago, you can see we're only at the 38%. If you go back, I don't know, you can sort of take the fib back on a longer time frame. You can see on this time frame, we haven't even got up to 38%. And of course, if we go all the way back up to the start of the downtrend, you can see that we're miles away, even for the most basic of retracements. So just from a Fibonacci perspective, this is not yet at all signaling, a complete reversal of the trend and the start of a new bull trend. We need some information, but we will start to get some information. Let's start looking at some of the hurdles the bulls need to overcome here. They need to overcome, first of all, I'd say this 50-day EMA. Then we have a nice bit of horizontal resistance and a nice level at about 99.30. And then if we also look, let's say something like the Bollinger Bands, which I do have here somewhere, hopefully. Here we go. Let's just throw in our Bollinger Bands. You can see here that, it was overextended at the bottom of those Bollinger Bands. So you could argue that once it gets up to the top of the Bollinger Bands here, that's all going to start coinciding here with some, moving averages, some overhead resistance. So I think this level here at around about, let's call it about 99 to about 99.25. That's going to be, I think, the first serious tests for the bulls and the bears. So the bears might want to come in and start selling there, and the bulls, if they want to keep this sort of rally, if they want to make it anything other than just a dead cat bounce, they need to push above there. So I think it's a little bit too early just at the moment to conclude that this is the beginning of a new bull phase. On the other hand, for sure, people who are long, the weak shorts here being sort of squeezed, anyone who's just got in here are going to be squeezed, but people with longer term or medium term sort of trend following kind of strategies are probably at this point observing this, but just waiting for a little bit more information. So obviously the sort of the flip side of that, we see the euro coming down here again, getting to levels interesting, sort of Fibonacci. Looks like a nice sort of a bull flag here. Let's see what happens with the PPI data today. But basically, you see that currency, the euro. You can also see the Japanese yen. Also being sort of a little weak here, a lot weaker than the euro, for example. And if we look at something like the pound, we can also see that that's showing a bit of weakness. So a little bit of strength in the dollar, but as I say, it's still a little early. I think we want to see what happens with the QRA, so the quarterly refunding announcement, which is happening in 12 and 14 days. We'll get those two bits of information. We're going to have the PPI today. So let's just look at the sort of the PPI and see what's expected. So really what the market wants to know is, will this confirm the data which we got yesterday? So keep in mind that, the data yesterday was sort of like a slightly upticking sort of CPI number. So if you look here at the PPI, what is expected, you can see compared to last month we had 0.1 for final demand month over month, expected to tick up to 0.2. If we look at the core number, excluding food and energy, that's also expected to tick up to 0.2. So it is expected to uptick, but if that gets up to, let's say, 0.3 or 4 or something, the market will be very unhappy, and we will see a continuing kind of flattening in the curve, probably continuing US dollar strength. The front end of the bond market will show extra weakness. And let's just see also what's going to happen with the equities, because equities was doing quite well, but we see that the VIX is up a point or so. But if we actually look at the equities, if we look at the ES, so the futures, you can see that I thought it looked to me technically as though it was getting primed to break out of this sort of sideways consolidation trading zone. But ultimately yesterday, even despite we had pretty good earnings from JP Morgan's and we're starting to get some of the banks, so quite good earnings. But what we can see here is that with the higher sort of real yields and nominal yields, and this sort of doubt that the Fed will cut and that inflation maybe is coming back. You see here that the equity is actually sort of selling off a little bit. Of course, technically this is nothing to be disturbed about, but just fighting it a little bit, just trading down towards the lower end of this sort of sideways range. Let's see what the PPI does today. And I think a lot of that, we also have to keep in mind that NASDAQ, for example, is outperforming. You see that even NASDAQ pushed higher yesterday, but just sort of taking a bit of a pause. But of course, we got some good news yesterday with NVIDIA. The fact that they're most sophisticated chips, it looks as though there's been some kind of deal between the Trump administration and China, that the Trump administration has said, hey, it's okay to sell the most sophisticated AI chips or just chips into China, and China in return will perhaps supply some rare earth minerals. But even the NASDAQ, which was outperforming the broader index, just sort of pausing a little bit. And I think, as I was saying yesterday, looking at the bonds, we really have to keep an eye on all of these bond yields here, because if we see, just bring those up, if we look at the 1 year yield, even that's sort of pushed up, which is unusual. But we look at the 2 year yield here, pushing up quite a lot. I personally, as I said, I think anything too much higher is maybe even going to be a buy for the ZT, the 2 year, just because we're getting up to the point here. If it goes too much higher than, let's say, 402, 404, something like that, up towards here, not only do you start getting some technical resistance, you see this is a pretty big level at about 404. It's also the 200-day moving average. We're now just crossing over the 100-day moving average. So there's technical resistance here, but also sort of mathematically, let's put it that way, at about 404, 405, that's sort of starting to say that the Fed will not be cutting at all, which does seem to be a little bit pessimistic and a little bit too hawkish. So we're getting to the point now that starting to look at some of the ZT. But if you also then go out to the 10-year, you can see that pushed higher, almost at the 4.5 level. And of course, the 30-year, you can see that that's now settling sort of above the 5% level. And what you can observe is that yesterday it pushed above, then it came back down to retest the 5% level, which is kind of lavender colored sort of dashed line here. And you can see that it's actually pushed a bit higher. So as we speak, it's at about 501%. And as I was saying yesterday, if you get nominal yields at 501%, which implies real yields at around about 3% or so, this is not wonderful for the real economy. And that potentially is why the stock market gradually will start looking at that and saying, not so convinced about this. And remember, I've read quite a lot of data, which it's not so much the level of the nominal yields, it's really the speed at which those yields are reached. So the problem is, if we start to get these sort of fairly aggressive moves upwards, you see here the last 3 trading sessions in the 30-year yield, the equity market historically does not like the speed of change. If you have this kind of yield move over 6 months or 12 months, it has no problem. But if this happens over, a few days or a week, 20, 30, 40 basis points, I mean, this starts to get the equity market's attention. And you can see here already, we're up about 15 basis points just in, the last 3 days. And if you go back, what's that, about 8 or 9 days, we're up about 25 basis points. So quite significant moves. And let's just have a quick look just to finish off with gold. You can see here gold. Gold's a little confused at the moment because it's saying, hey, American or the US, the fiat currencies are being debased a little bit. Inflation seems to be sticky. On the other, and of course we've got the high yields. So gold just sort of trading in a sideways range just at the moment. Actually, I just want to have a look at BTC here, because that had broken out, as we all know, up to sort of new highs. Just taking a pause. If you look at here on the measured move, the Fibonacci extension here, just reaching that level here. But this is still a very bullish chart. You look at these, the moving averages pushing higher. Okay, guys, I'll leave it there. I think that's all we've got today. It's just the PPI in terms of the data. Let's keep an eye on Trump if he wants to tweet anything out. But again, the market, especially the front end of the curve, to see if it wants to flatten again, and the dollar, it's going to be determined probably by the PPI. If that comes in very soft, there could just be a bit of consolidation or sort of profit taking on some of those big market moves we saw yesterday. On the other hand, if the PPI comes in higher than expected, a little bit hot, that could keep dollar strength going. It could see the sort of bear flattening continue in the bonds. So we see that the front end yields going up aggressively, but also the long end yields going up, and maybe equities finally being slapped around a little bit by these high yields and the strengthening dollar. But we'll see all that in about an hour or so when we get the data at 8:30. Thank you. Have a great day, and we'll keep the conversation going.